So, can you retire on a 25% yield? Is it too good to be true, or did we just find a revolutionary product? Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Growth investors, bonjour, Mike Leroux here. You're listening to the Dividend Guy podcast. I hope you are doing well because we have a hot take on a hot ETF today. And I am with my co-host Vero, and we're going to try to do a good job on this one. How are you doing, Vero? Are you ready for this?
Well, now I'm a little scared because I can feel your energy, and I'm like, okay, this is going to be like a great one for sure. One that we will remember. That's like, let's put it that way.
Yeah.
So, Mike, there has been a trend over the last couple of years, and it's covered calls. They all come with the promise of a high monthly income. So today I'd like to know, did we just got it all wrong and should trade our individual stocks for them, or is it too good to be true? And to do so, we will use one of the most recent ones that is making the buzz, HHIS.TO, HHIS Diversified High Income ETF.
Yeah, there have been a huge evolution in this space. I mean, the first covered call ETF started around 2012 or something like that. And since then, the number of covered call ETFs and the different strategies has blown off, like literally. And I can get it. I mean, the more you invest and you get close to retirement, the more you kind of crave for income. You want to replace your paycheck. So one day you're going to stop receiving the paycheck from your employer. And in an ideal world, you would just turn back and receive the paycheck from somebody else. And that somebody else could be covered call ETF. So it feels good. And then we have a new wave of covered call ETFs mixing leverage and trend in stocks. And this is what we're going to look at when we are going to do that deep dive with HHIS Diversified High Income ETF. It's an ETF of covered call ETFs. So there's a lot of them. And I mean, for people that have been listening to this show for a while, I have to come with a word of warning. Many income investing investors will tell that I have a bias against those type of products. I've done like multiple work on them, telling you that you're trading yield for leaving a lot of money on the table. And if you're fine with having lower return for the sake of letting a financial firm creating an income instead of you creating the income for yourself, that's totally fine. But I just want to go back to that notion of total return throughout this show. And my goal here is not to destroy or praise the ETF, but just comment on the numbers and see exactly it as like mathematics, not necessarily telling you it's good or bad. Actually, there's a lot of good things that I have to say about HHIS. So you kind of like be surprised about this, but there are like some non-negotiables. We'll end the show on those non-negotiables that I cannot ignore. But overall, the goal here is really to be as unbiased as possible. So I'm not trying to say, will I invest in this Harvest fund? Of course I won't. But can it be useful for somebody else? And this is what we're going to try to figure out today together.
All right. So, Mike, I did my research and I went to HHIS website, and here's the overview. And bear with me, listeners, it's a little long, but it's worth it. So the HHIS Diversified High Income Shares ETF offers a multi-sector portfolio that captures a diverse selection of trending companies that are positioned for strong growth. It is designed to deliver consistent, high monthly income alongside growth opportunities. This ETF holds a portfolio of HHIS single stock ETFs, combining the benefits of income generation with exposure to leading businesses across various sectors. So that's a lot of words. If we put the firm speech aside, like what does it mean exactly? I'm lost.
First, it's an ETF of ETFs. So like HHIS Diversified High Income Fund is investing in their own one single covered call ETFs. Out of those, you have 14 covered call ETFs that are almost equally weighted. It goes from like 8% to the smallest one at 2.5, and I'm pretty sure that that's the latest addition they made was Apple. So it's probably going to grow a little bit over time, but roughly almost fairly spread across those 14 stocks. One thing that I find very interesting here is their take on the stock allocation. They're going for leaders and popular stocks and trending stocks. They use
Mhm.
that the word trending in their own verbiage. So they focus on companies that have a lot of hype right now, that they're doing a lot of things, thriving companies for some of them. We're going to talk about those. So one thing I'm asking myself already though is, can it continue to perform forever? I mean, like Tesla, for example, was a darling for several years. In 2025, it's a little bit tougher. I'm not saying that it's going to
Mhm.
crash and burn, far from it, but just to think that many companies will not be literally exploding for like 10, 15, 20, 25 years. At one point, unfortunately, things change. So you have to modify. And I'm sure that that's what HHIS will do over time. They will probably like modify the allocation, but trying to capture as much growth as possible kind of sounds like a good strategy. And even more than that, since they're writing covered calls on those stocks, well, if they are trending, it means that there's a high demand. And if there's high demand, chances are it's probably easier to write covered calls and options on
Mhm.
those companies because there are more investors interested in buying those options. So I can see where it makes sense. I can see where it's trending, and I can see that a lot of investors will kind of like the stocks that are inside the hood, if we can put it that way.
Okay, so looking at its holdings, we can find high growth stocks like Alphabet, Nvidia, Costco, Netflix, Amazon, etc. Mike, you usually look at the top 10 holdings to decide if an ETF is of good quality or not. So seems on the right track here, don't you think?
Well, it would be hard for me to dispute that since I hold Microsoft, Amazon, I have Costco shares, and I wish I held some shares of Broadcom on top of that. So it's already like four companies out of 14. A lot of great names across that as well, like you mentioned. So definitely they are on target with what they said they would be doing, aiming at growing stocks, trending stocks. It's definitely the right place. So when you look at those company names, you're just like thinking, well, I'm in good company right now. So many times I say when I look at an ETF and I look at the top holdings, I find companies that I don't really like. Well, those are not necessarily all dividend payers, so I cannot comment on all of them. But if you look at the past like 2, 3 years returns and even more than that, they're definitely thriving companies.
Okay, but then I hit the product sheet and I read this: invest in single stock ETFs that use leverage for increased income and growth potential. So, again, what does that mean?
So I see that you did a good job of like going on the website and starting to educate yourself to try to figure out what's
I
going on.
tried,
And
yes,
that's
yes.
but that's super important for any type of products, especially with this one, because you'll see you have like three components of potential growth slash income here. So you have the stock itself, because of course, if you hold shares of Costco, chances are it's going to go up over time because it's a thriving business. So you have the stocks that could go up, and then the company can write up to 50% of covered calls on those. So they will hold a good chunk of those shares in any cases because they're not going to write 100% covered calls on all of this. So it's impossible for them to get rid of Meta, for example, from their portfolio. Worst comes to worst, they're going to lose, well, not lose, but they're going to sell 50% of their shares under the covered call option. So they get the premium and then they get to sell at a profit, which is not that bad, but they will continue to ride a good part of that growth. So that's the second part. And the third part is they also use leverage. So up to 25%. In general, what they say is like between 20-25% of leverage. So when you borrow money to invest in a great company and that great company offer great returns, well, you amplify your returns by the same thing because it's money that you're making that is not even coming from your own capital. So that's the good side of using leverage, because the bad side is obviously you borrow money and you invest in the losing stock, so then you lose money on the investment and you also have a debt, so that could be the downside. But right now for most of those stocks, well, it's on the good, it's on the positive side. So you have those three components jive together to generate that crazy yield of roughly 25%.
Okay, but Mike, still, how does HHIS generate shareholders' income? Like, it's still unclear to me.
So what they will do is that when they write, like it's a combination of those three portions. So when they write covered calls, they will receive money because you're selling the options, meaning that you receive money from it. And the good, like the ideal world is if you can stay within price range where you sell the option, but you don't, like the investor is not going to exercise that option. So you keep the shares and you're just gathering more money out of it using the leverage. At one point you can sell some shares to pay back down the debt on a profit, so you are able to generate more money from that. It's also tax efficient, so a lot of the returns is actually either return of capital, so receiving your own money back, or capital gains, which is less taxed than the classic dividend stocks. So overall, from the infrastructure of the product, it seems like a pretty solid way to offer a distribution to investors.
But Mike, what's the mechanics of a covered call again?
Yeah, because that's something else that you have to figure out, right? I mean, you cannot just say, oh, yeah, well, this company is like generating 25% yield and it's all good. And if they say they're going to pay me 25%, it has to be true forever, right? So here's the mechanic of a covered call. So let's say that you own shares of a company trading at $100 to make it simple. So you have those shares and you're selling the option. So you're writing the covered call. So covered means that you own the shares, and the call option is giving the right to somebody else to buy those shares at a specific price. So they trade at $100 and you sell the option to another investor to sell it at 110. So the investor that is buying that contract believes, of course, that the stock will go way above 110 and he's willing to pay for having this option for a specific amount of time where they have a chance to actually buy it at 110 when it trades at 150, for example. So they're going to give you, let's say, $2 for that option, which is great because that $2 on $100, it's 2%. That's pure income, and you didn't do anything at this moment. You still own the same number of shares at $100, so your portfolio value has not been touched, but you receive a 2% premium for selling the option. So that feels good. Now, moving into a few months later, if the stock stays below 110, there's no reason for the contract buyer to exercise their option. They don't want to say, well, if it trades at $105, they're definitely not going to want to pay you 110. So they're going to let the contract expires at maturity. So that means that you still hold your shares. They are still trading at whatever price, but below 110, and you keep that $2 in your pocket. So that's great because you just boosted your returns from your existing position. If the stock price goes down, like $90 or $80, same thing again, nothing happens. You still hold your shares because nobody wants to buy them at 110 if they now are worth $80, but you keep the $2 extra. So that's kind of like a buffer when the stock price goes down. So it still goes down, but a little bit less because you got that 2% premium. But if it goes up, well, you cap your gain. So if the stock price skyrocket to 125, you are forced to sell it at 110. So you're making profit. So you're making $10 a profit a share, plus the $2 that you wrote the option. And the investors buying it at 110 actually makes another $13 in profit. So the $15 of capital gains minus the $2 that he had to pay for the option. So you are leaving $13 of potential profit on the table while the other investor is going to make it in its pocket. So long story short, when you're writing covered calls, short term, you're making more money, but over the long run, technically, you limit your gains. And when you think about that, well, chances are, I don't know, but chances are the stock market will eventually be higher than today level. Maybe not. Maybe I'm totally wrong and the stock market is going to crumble down to zero and then it's going to be the bankruptcy of all companies in the world. But I tend to believe that in 10 years from now, the stock market will be higher than today. And then in 10 years after that, it's going to be the same thing. And
that's the
you
point,
will,
right?
yeah, I mean, that's the point of investing. If you don't believe in that, I mean, stop investing in companies and put your money elsewhere because there's no point. So you get short-term income, but you limit your gains, so you leave money on the table. That's the basic of any covered call strategies.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water. which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. Okay, but in 2025, we mentioned volatility like almost daily. So, what are the limitations or risks of using covered call ETFs during a high volatile market?
Well, actually, it could be good and it could be bad at the same time, which is kind of crazy. Because if you have like a lot of things going on the stock market, that's good because it means that there's a lot of volume and a lot of demands for buying a stock. So, same thing with options. So, that should be good. If a stock jumped by 10% on a single day, though, you increase your chances of getting exercised, meaning that the contract would put in effect for a very short period of time, but you're forced to sell. And if the stock price goes back down right away after, you just sold your shares. So you limited your gain, you lost your shares. Now you have to buy them back to write more options or allocate your capital elsewhere. So it kind of like go both ways. One thing I want to highlight though is during a bear market, when the market goes down like by 20, 25, 30%, there's a recession, like things are not going well at all. A lot of investors will think, well, it's a good thing because I'm going to be protected by those covered calls. So I'm going to write those covered calls, make a little bit more money. But that protection will also reduce. It will reduce because you're going to have a hard time finding people wanting to buy a stock at 110 when they believe it's going to go down to 80 bucks. So they're not going to pay the same premium. So they may be, instead of like in my example with, or just like made out numbers, but instead of paying $2 per contract, they may pay like 50 cents. So yes, you have a protection, but it's not the same amount anymore. So that is also another kind of problem. But that only happens when there's a bear market. When there's a lot of volume and volatility like we saw right now, especially if you go back into an uptrend, it could be very good to write cover calls. And that's the sweet spot where you want to be. You want to write the call option just below the strike price that it's going to reach. So if you would be able to write covered calls on a stock at $100 and every single time it goes to expiry, it trades around like 108 or 109, you kind of have like the perfect of both worlds. You get the income, but your investment is still growing. So that would be the perfect situation. Unfortunately, it's pretty hard to have that kind of like crystal ball that will tell you exactly where the stock price will end, but that's where the sweet spot would be.
Okay, but Mike, how do covered call ETFs compare to traditional dividend growth stocks in terms of income generation and long-term capital appreciation?
So that's a tricky question. So we're going to start with previous covered calls for a second and not talk about Arvest right away because, as I said, they use a different strategy for writing covered calls. Only 50% of the shares are going to be used for writing covered calls, and they also use leverage. But if you go back to the classic covered call ETFs, such as like ZWB, a BMO covered call ETF on Canadian banks that exists since 2012, which is great because you can do a long-term analysis on it. Or if you look at stuff like JP Morgan income products, GEPI, that is supposed to be compared to the S&P 500. Well, you can run the calculation as you want. The total return will always be better for the underlying asset. So for the S&P 500 or for the 6 Canadian banks versus the covered call version of it. For the reason that I just explained, over 10 years, chances are the S&P 500 will end up higher up. And eventually, you're going to limit your gains a few times while you write those covered calls. So you're not going to capture all the gains. So it makes it almost impossible for the long run to beat your benchmark. While investing in the benchmark is actually quite easy. The second thing I did on those two ETFs, I did those on YouTube actually. I ran those calculations. So I opened like the data spreadsheet. I built a huge Excel spreadsheet and say, okay, imagine I have $1 million and in GEPI, and then I have another $1 million that I invest just in SPY. So a classic S&P 500 ETF, like nothing fancy. And I did the same thing with ZWB versus ZEB. Same thing, just going for the underlying asset instead of the covered call strategy. And every quarter, I sold shares of the underlying asset, so the SPY, to match the distribution. So I just say, okay, so roughly the yield is around 5%. So imagine that I want to retire on 5% income. And every quarter, no matter if the market goes up or the market goes down, like I made absolutely no decision about that. So it's really the following trading day after January 1st, same thing for March, same thing for every single quarter. I just sell to create 5% income instead of just receiving the distribution. And in both cases, the strategy of selling shares at a fixed date, so there's no strategy here. You don't have to think about it. It literally takes 2 minutes every quarter where you open your brokerage account, you calculate what is 5%, and then you sell. That's what it is. Well, every single time, surprise, the underlying asset outperformed the covered call strategy. So even thinking you want to invest to generate income, if you create that income yourself, instead of letting a financial firm creating that income, you still have more money in your pocket. And that totally makes sense because, again, you're capping your gains by writing covered calls. So that's the biggest flaw. The biggest flaw is you have the illusion you're getting income. I mean, you're getting income, which is great, but you could have generated that income anyway using the exact same strategy, but just skipping the covered call part, and that would work. Now, HHIS is different, as I said. They don't write the covered calls for the entire portfolio and they have leverage. And the other thing, unfortunately, is while it's different, it makes it sexy, it makes it new, it makes it enticing. And I'm just like, oh, this one's going to work. Well, it is too early to tell officially because we're not even like 12 months in, and even 12 months would be super short term. In my opinion, we'll know exactly in 10 years from now. So it's a little bit late, but at least we're starting to like monitor, we're starting to talk about it, and then we are going to look at it. Keep in mind that the context right now, since HHIS exists, yes, we had Liberation Day in April, and a lot of people will blame all kind of things about this moment where the stock market dropped in April of 2025. But the stock market today is up. That's what it is. Yes, it was. We had volatility. That's fine. I mean, come on, guys. It's not the first time that we have volatility in a year. So please stop blaming Trump for everything that happens in your life. I mean, he's responsible for some. I'm not denying that, but I'm not going into politics either. The stock market is up. And because the stock market is up, and especially most of those great trending companies are also up year to date, that also helps the fund looks good over a shorter period. That's totally fine. But that also makes people asking less questions. They don't really care because they're up. They will often say that, oh, if I count the distribution and the investment value of my portfolio, I'm in positive. Well, I never said that you're going to crash and burn and run out of money within the next 3 months. What I'm saying is you could have made more money actually if you had invested in the underlying asset.
And like you said, Mike, with your example of creating like a 5% yield, I mean, it's really simple. It's even simpler than writing covered calls, in my opinion. So anyway, I still want to compare one thing. If we take HHIS portfolio and create another portfolio of the same individual holdings without the covered call or the leverage strategy, what would be the result?
So that's great because somebody else did it for us. So we don't have to run the numbers. I love it. And if you go on YouTube and you look for Dividend Empire, he did a great job. He did a few videos actually about HHIS, but one his take is HHIS beats the NASDAQ. So he compares to the NASDAQ 100, like the 100 stock. And that was a really interesting video. And on top of that, you have the Google spreadsheet that he uses to compare every single stock with the covered call ETF. He focuses on total return, which is great because too many people focus on just one side and forget about total return. And I mean, if you forget about total return, you forget about investing altogether. So it has to be total return or nothing else. So he did a great job on that. His take is true as well for the period that he did. Again, it's like not many months. Keep that in mind. But it is completely true that HHIS beat the NASDAQ for that part. Now, statistically speaking, if you select 13, 14 stocks out of 100, chances are it's possible that you beat the average, the index. It is very possible. The same way I select about 30 stocks in my portfolio, well, I do have chances to beat the S&P 500 or the market as a whole because I'm selecting like just a handful of stocks and the benchmark is stuck with all the companies. So the good,
Mm.
the medium, and the bad one as well. So that's, I
Right.
mean, you could go either very wrong, you could go either very good, or you could be in between. So super easy, especially for a short period of time, to beat an index. That's totally fine. In 10 years, we'll have to see, but for now, that makes sense. What really caught my attention though in this Google spreadsheet was not his take about the NASDAQ, but rather looking at the comparison he made between investing in Microsoft versus the Microsoft ETF, in Tesla versus the Tesla ETF, in Amazon versus the Amazon covered call ETFs. And out of 14 stocks, how many covered calls do you think beat the underlying asset out of 14?
I don't know, half maybe?
How about two? Like 2 out of 14. And strangely, the losing stocks, so Eli Lilly, Tesla, and Costco for that specific period of time, like the stock was down. Actually, the covered call ETF was lower. It offered like a worse performing total return than just investing in the underlying asset. So the average stock, if it was completely, and of course there's different dates, there are different weight positions. So that's not what I'm doing here. But on average, those 14 stocks were up 25% total return. So that's capital plus dividend if they pay a dividend. The covered call ETFs together on average, so the same average, the same numbers, right? They were up 19%. So that's a 6% difference. It's huge. It's not just 6%, it's 6% on 25. So it's like a quarter better performance for the stocks versus the underlying asset. It is very massive. And one-on-one, again, 12 out of 14, it's better to buy the underlying assets. Like again, I have to repeat it, very short period of time, but it's a really bad start. It's a bad start in the sense that it's not going towards the right direction. It is doing less, which again, not really surprising, but it's really just want to talk about the numbers. Yes, you are positive. Yes, you made money. HHIS, as of like July, when we took all the numbers to do this episode, was showing positive return. And it was beating the NASDAQ. So I'm not denying that. What I'm just saying is if you add just copying the 14 stocks, which is quite easy to do. I mean, it's 14 companies. It literally takes like 10 minutes to build that portfolio on your brokerage account. Well, you would have made 6% more, roughly. So just to think about that.
Mike, I would like to add a question about like the trending aspect of this ETF. What's the risk of like chasing trendy stocks like this? Like, is there any?
Well, that's another thing. I mean, you have companies like in this basket. I mean, I've mentioned the companies that I love, but companies like Coinbase or MicroStrategy, they're going to do well as long as cryptocurrencies are doing well. If cryptocurrencies crashes again like 21, I would be very curious to see how well they will do. Because, I mean, they're all about cryptocurrency. So I'm not saying it's a bad thing or a good thing, but again, very trending. Now, do you really think when like companies are exploding like this, they can maintain that for several years, decades? I mean, I'm not a fool. When I look at my portfolio, I know that some companies will have to go at one point because their honeymoon phase or their exploding phase will be over. And we have discussed that at one point with Alimentation Couche-Tard, for example. One day, it is very possible that this company become more mature, find less ways to grow, the yield would go up to 3-4%, and then the double-digit growth era would be over. Well, at that time, I will have to sell and move on to another one. So chasing trending stocks is also about based on the same thing. There's like, it's like NVIDIA right now. They're growing like there's no tomorrow for the demand for AI chips. But eventually, one day, they're not going to be able to double their revenue every year. Or like, I don't even know like the pace at how fast they grow right now. But it's not sustainable forever. So at one point, of course, the stock price will not skyrocket like this all the time. But it doesn't mean it's going to stop tomorrow. It's going to continue for a while, that's for sure.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers. And we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. Okay, so let's go back to taxes a bit. HHIS promotes tax efficiency. How does it compare to the tax treatment of dividends from individual stocks, like especially for Canadians?
Yeah, we really have to talk about taxes. I hate taxes. To be fair, and this is why it's important to talk about that part, HHIS distributions are definitely better than a dividend paying stocks in an unregistered account. As I said, a good portion of it is return of capital or capital gain, where if you would use the dividend growth approach, you would have a mix of dividend and capital gain. So of course you would pay more taxes. And one of like the basic principle of tax optimization is to defer tax in time as far as possible. By receiving return of capital, this is what you do. So that totally makes sense. They're totally true about that. And it's right. They have a better way to generate distribution than if you would try to generate 25% income from dividend stocks.
But then I've heard like some investors say that they don't rely on HHIS or similar products for income. Instead, they reinvest everything. So does that make sense?
Well, it makes sense in a sense where you have to, as I said, you have to consider total returns. So the distribution you receive and the share value of what you have are like the two components that you need to put together to know what's your real rate of return. The thing is, if you look at the first generation, and that's not HHIS yet, but if you look at the first yield max, they all started with crazy yield, and then you see that the unit price goes down super fast. So, and even if you look at like TSLY.TO, that's the Arvest Tesla Enhance High Income ETF, it started around $12 in February. Now it's trading under $7 in July. So you have to reinvest all the time the distribution to kind of like have a hope to, yes, you grow your income in one side, but that income is, you're kind of like forced to reinvest it. So it's like, I would offer you a $250,000 job as long as you put $200,000 back in the business every year. So is your salaries really $250? And knowing that the company's value is actually going down every year, I mean, I would argue that you're making 50 grand a year. This is what you're taking home. The other extra 200, you're not really taking it home. So I would put that. Total return for TSLY as of July 10th was minus 38. And of course, it is not a good year for Tesla at the time of recording. But if you look at Tesla stock, it's down 28.5. So there's almost, again, a difference of like 10% between reinvesting everything and your portfolio value down the road. So those distributions have been reinvested and still you're down 38% versus being down 28. So you get the income, but at the same time, it's not exactly perfect. If we go back now to HHIS, at the time of recording, again, mid-July, the ETF price is about the same as it started. So like there was fluctuation, of course, but that's normal. I mean, it's expected for all kind of investment. So that's not the point. And total return right now is roughly around 13%. So they are on track to generate that 25% yield. So all that, it kind of like tells you the opposite of what I'm telling you, that it's not sustainable. Because right now, after a few months, they are able to generate that 25%. They're on track to make it happen. But again, if we go back to the Dividend Empire YouTube channel where he makes the comparison, on average, those stocks generated a total return of 25%. So kind of like totally making sense that right now they're able to distribute the yield and still the value hasn't changed. Now, do you think that it's going to be something that's going to happen forever? That's another thing. I mean, I can go back in time and say, well, my investment in Apple, the first time I invested in Apple was in 2014, so more than 10 years ago. And I could have sold 25% of my shares of Apple like every single year. And still I would be making money because my total return is above 1,000%. So that would make sense. I would all be good for that. And I would be able to create that 25% yield based on my initial investment for all the time. So it's not 25% shares because each share grows in time. And at one point you just sell one share and then you cover the whole thing, like figuratively speaking. So feeling of but when you think about that, how many companies are able to maintain such level of growth? So there is kind of like a bet here that the 14 stocks that were selected will be able to generate 25% annualized return for several years going forward.
Right.
And that's a huge stake. I mean, I would not be that confident in my portfolio.
Okay, but let's try to give this product a chance. What if I don't want to manage individual stocks and I want to go for like an annuity-like product with higher income? Can HHIS be a reliable option?
Well, let me be clear. HIS is not an investment atrocity. It's not the worst product ever created. But if you're thinking that you can rely on 25% income for the rest of your life, that is another type of problem. I mean, think about that. You only have to gather $200,000 to retire and live on 50 grand a year. I mean, just saying that sounds too good to be true. Like I would be able to live like a freaking millionaire today. I would just like borrow for $1 million, sell my house, buy this, wait 4 years, so pay back all the debts that I have because I borrowed $1 million, and then live on $250,000 a year. Like I would live like with a great lawyer or a doctor's salary for the rest of my life just by doing this. That's kind of crazy. I don't know. I don't think it's like something that could really happen in life because it has not been. I mean, I haven't seen that yet. Doesn't mean it's never going to happen. But when you're thinking about out loud, you retire age 55, let's say, $200,000. He's easy to gather. And then you're up 50 grand a year, guaranteed, no problem. I don't know. Seems like too good to be true in my mind.
Okay, so in your view, how should an investor evaluate whether a covered call ETF fits their investment goals?
Well, the very first reason, and this is what we started this show today, is to understand what you buy. Really, really important, because I even noticed in the comments in the video done by Dividend Empire that was really, really well done and interesting. Most people focus on the fact that it beat the NASDAQ and completely ignore the fact that it didn't beat the underlying asset. So it's kind of strange for me. It's like, imagine that you take among the best like 30, 40 scorers of the NHL last year, and you pick only 14 out of those. Chances are 5 months in the next season, their average points per game will be better than if you take 100 NHL players. Like that kind of like makes sense. I mean, if you have McDavid and McKinnon in your lineup, chances are their average point is going to be slightly better than Trent Frederic. Maybe I'm wrong, but I don't know. Like I'm just saying. So that is like a problem that you really must understand when you make the comparison. And then it's only 14 stocks. So it's super easy to make that comparison anyways. Once you understand, and if you're willing to say, well, this is a great package of stocks, I'm not going to deny that. The structure is interesting. So that's fine. So in the end, are you really going to lose a lot of money with this? I don't think so. The only thing that I have, and that's the non-negotiable that I was telling in the intro, is it's not sustainable. Like the 25% per year is not going to happen. I mean, if you think about that, using the same example I did earlier, so you retire early with that $200,000 and then count just 2% inflation. At 65, you need 61,000. And then at 75, it becomes $74,000 per year out of 200. Really? And that's sustainable? I mean, can anyone believe that you can actually generate that? So if you're telling me, but Mike, you got it all wrong, I reinvest in those shares, fine. Don't say that you're making 25% income. It's not income if you have to reinvest. It's income if you take it away from your portfolio and you spend it. That's income. Like when I receive a paycheck from my business, I don't have to put anything back in. I receive that money. It's mine to pay. Well, minus taxes, of course. That's why I hate taxes. But the rest of it, I can spend it the way I want. I do not have to reinvest it inside my portfolio. So that is the huge distinction, because it's not true that you put like $1 million there and you wait 4 years and your portfolio is up at 2 million now, and then you can pay back your loan and then live on $250,000 for the rest of your life. That's not going to happen. And even though it's really early in this stage to say that, I'm willing to bet $1,000 with anyone who's willing to sign a contract with me that it's not going to happen for the next 15 years. Of course, in 15 years, $1,000 is not going to worth much. But anyways, you get the point.
So to summarize all this, Mike, what are the main trade-offs between earning a higher yield through high-income products and giving up potential capital appreciation?
So the story, the narrative behind HHIS is nice. It's well built, great stock selection. I'm not denying that. What I'm just simply saying is it's going to be super easy to copy HHIS holdings. And if you hold those stocks in the same percentage, you're going to do better than HHIS. It's going to take you 10 minutes to do it, and that's fine. Again, the 25% is not realistic. The first yield max that have like more than 1 years old of data shows that it's not realistic either. It's going to work until it's not. And the point is, over a few months, it is very possible that your portfolio goes up by 25%. I mean, we just had 2 years back to back. 2023 and 2024, the market was up more than 20% per year for 2 years in a row. So your personal performance, regardless if on whatever you invest, it's very possible that you average a 25% return for 2 years. Very possible. Now, are you able to maintain that pace for the next 30 years? Well, I have good news for you. If you're able to, you're going to be the next Warren Buffett. So your fortune is going to be counted in billions of dollars, not in $100,000. So that's going to be crazy. And that's great. So long story short, there's no free lunch in finance. If it's too good to be true, then it probably is. You know, I had to argue back and forth for several years about BCE that is likely going to cut their dividend because it's not something that's going to happen for almost 2 years. I argued with a lot of investors and they told me I was panicking, like I was like going to the extreme and everything. Unfortunately, none of them came back saying, "Oh shit, Mike, your math were working," because math don't lie. So yes, you can come to the YouTube channel. You can call me crazy if you want. You can tell me that I don't know what I'm talking about, and that will continue to generate 25% total return, because that's total return we're talking about, not yield here, for the rest of its life. Let's talk about that in the next 5 years, because in the meantime, we'll have to wait. So that's my take on it. But you're probably not going to lose money on this type of investment, just to be clear. It's not something that is going to destroy your retirement plan either. I mean, the lineup of stocks is great. So I believe that there's a potential, and right now it is doing great. So I'm not denying that. I just don't want people thinking that they can withdraw 25% of their capital every year and retire happy. That's just the main point here.
Well, thank you, Mike, for this deep dive into HHIS Diversified High Income ETF. Listeners, remember that there's no free lunch in finance. To create a sustainable dividend income, enter your name and email at thedividendguideblog.com/income to download the Dividend Income for Life guide. For our show notes and related content, including Dividend Empire videos and a video that Mike did about other covered call ETF, visit thedividendguideblog.com/239. Next week, we will discuss the stocks Mike has on his radar. Hit pause and the subscribe button underneath our podcast logo so you don't miss it. And until then, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guide Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.